Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, as I mentioned in yesterday's video, all eyes would be focused on Chairman Powell's statement. And I also suggested that we could see a shock and awe statement, otherwise a major shift in what the Federal Reserve is going to do. As I talked about the potential for them bringing in an inflation component, that's exactly what happened. It was almost as if I had gotten hold of the script before Powell talked yesterday. If you recall, a few days ago, I was talking about the evolution of the Fed and how it was time to change. And what better time to take and make this switch in the middle of this pandemic. They are going to take advantage of every opportunity they get. This is a complete restructuring of the financial system and social hierarchies throughout the world. We're going to see even more when we hear the joint statement coming out of the symposium from all the central banks. I told you today's speech would just be the beginning. Everybody's been discussing what the Fed said today and what their interpretation of it. Let me give you mine. There were several things in the presentation that Powell did, and the first thing was going through the history and talking about the Great Moderation, which was the Paul Volcker Greenspan era, where they were fighting inflation, and that was the main goal. I came into the markets in 1979. Jimmy Carter was president. Inflation was running rampant. And to Carter's credit, he put Volcker in office, and Volcker went on the attack. In fact, there was a recession in 1980, and Volcker raised interest rates in a recession. We had the most horrific economic scenario that you can imagine, which was extremely high rates. The long bond was at 16.5, and the Fed funds were trading at 20%. We're talking credit card type interest, and it was absolutely scary how out of control everything felt at the time. The bond market had volatility that almost would match what we saw in the stock market this year. It was absolutely crazy, the type of volatility that we saw, and it was mostly being caused by many of Paul Volcker's actions that he took. Paul, after discussing the Great Moderation, he discussed the next phase of Bernanke and Yellen. And that was the transparency, letting the public and all institutions have complete transparency on what their goals were. They had all types of targets, including employment, inflation, you name it. That's how the Fed operated during those years. The standard that was set in stone at the time was 2012. So we spin forward 8 years later. Now the Fed is changing up all of the metrics, how they're going to look at the markets. Paul got very creative yesterday as he discussed a new math, flexible form of average inflation targeting. I'm not even sure what that means, but he seemed to be very confident when he said it. What I think that meant is that they're going to just take the gloves off and they're going to do what they have to do to get inflation to come back in. He used a term that he's used several times, is that the Fed will use a full range of its tools to make these things happen. What I heard then was they are planning another big money pump. I think there could be another $2 or $3 trillion coming into the market. That's what I heard. I heard we're going to add what we need to do to get this inflation to really start to kick up. They'll take the balance sheet to 12 to 14 trillion if they have to. They are fearless right now. And what we're seeing is a complete restructuring of the financial system, the metrics that people are going to look at. There's going to be a number of things I believe will start to happen. In last night's video, I also told you you weren't going to get a lot of details. These were all real fluffy statements that he made. They will start to reveal the process of what types of strategies that they're going to implement over time. We will get a joint statement from all of the central banks, which I think will embellish a little bit more of what Powell said yesterday. So this game's not over yet. We have another round today, and I suspect this will be another positive shock and awe treatment, only on a worldwide basis. Last time we saw something like this was back in 2011 when the central banks were working together to avert a major financial crisis in Europe. That was our fear, if you remember back in those days, that everything was going to roll over. We hardly got out of the woods on the 2008 scenario, and here's another major crisis. If that happened, we would go into a major depression and so forth. It didn't happen. They coordinated. They put a lot of money into the markets then. They actually moved the equity markets almost in 14 days. They moved them about 11 to 12% higher in just 2 weeks' time. The other side of this is that all of the governments are going to be participating as well. I've been telling you this in a lot of detail over the last several days, that there will be a matching program. And in spite of the division that we have in the House and the Senate right now, once the Fed starts to show up with some money, you will see a deal so fast between the House and the Senate, it will make your head spin. This will be absolutely amazing event, I believe. And this is not only just going to happen in our country. This will be all of the Western central banks and governments teaming up to make this happen. I believe that the central banks and the governments see this particular situation as a major event to restructure society and the financial system. As we listen to the joint statement tomorrow, I expect this will be further bullishness that will come into markets. We're likely to see the S&P finish over 3,500 today. We had a very sloppy close today. I'll go through all the details here in a few minutes. But just understand that we're not done with this particular event yet. There's one more round today. Any economic reports that come out today have no bearing on anything. That's not going to affect sentiment at all. It's going to be all about what Powell said today and what they're going to reveal tomorrow. It's going to be an ongoing process over the next several months as we go forward. I've been telling you that I think the metrics in the economy is going to start to waffle a bit as we come into September and October. Sure, they know that too, and so they're getting ahead of the curve. He also mentioned that word, that they want to be ahead, they want to be forward-looking. They're already in the game. They're going to throw a deep pass. They've got a receiver out there. He's wide open. This will be the beginning of a major deal. Continue to discuss the things that I've talked about this week. We're going to continue over the next 2 years the movement out of the cities into the suburbs and a continuing restructuring from a geographical viewpoint as well. So there's going to be a lot to deal with here. America will be changed forever, as will every country on the planet. What we're witnessing real time, I believe, is a major shift in history. There's going to be a lot of innovation that comes out of this. I went from 4 months ago being a pessimist to an absolute optimist. Let's take a look at the charts, see how Friday's looking to close, and how we're going to set up for next week as we come into September. Reviewing the WaveTech database, one of the things I discussed in last evening's video is that I continue to expect to see the short-term database see a liquidation, and that's exactly what happened. We had about 1,000 new sells. In spite of the all-time new high, we're continuing to see a lot of these old trades start to peel off out of the database. We saw roughly 1,000 sells and only 150 buys, so we have a net 850 on the liquidation side, pushing the percent bullish down to 60.5. Still expecting to see this percent move down into the low 40% level. This is just a normal cycling of the database as everything gets so extended. Also, as I mentioned last night, the fact that this database is liquidating doesn't mean that the markets are going to roll over. Last week, when we were at a critical support level, there was a possibility for liquidation of the database and a decline. Well, that all went out the door last Thursday when we got that big reversal. Here we are trading the S&P at or above the 3,500 handle. So we're continuing to see this liquidation. It's going to be interesting to see what happens on the intermediate database, as when the servers run on Friday night, they'll be updating all the weekly graphs and all the weekly signals. My expectation is we'll continue to see more traction come in on the intermediate database. As we review the S&P futures, I'm getting this video done very late because of the video issues I had earlier, but we're seeing a lot of selling come in the first hour of trading in London. We pushed the market down from a high earlier in the session from 35.09, trading all the way down to 34.85. And as you look at the market grid, S1 is 34.76, and we have an R3 of 35.12. So we came close to an R3 trade, and we haven't quite reached the S1 trade, which would be 34.76. That would be another 10 handles below. But we're also continuing to see the daily volatility blow up a little bit more as the markets are seeing much more volatility than what we were seeing 2 weeks ago. So this continued expansion of the range is causing these wider ranges to be set up. So it's possible that we could see an S1, see some retracements with the statements that are coming out tomorrow from the Jackson Hole Symposium. I still expect to see a bullish statement come out of these folks, but definitely a lot of selling coming into London as the markets open tonight. But the configuration, we're still seeing a positive tone across the board. PPM1 is a plus 0.38, PPM2 a plus 0.34, and PPM3 0.27. These are updating real time, and so this is a very robust market. The support is well below the markets, way down at 34.23, so we're not anywhere near triggering or a rollover of any sort. The expectation for today will be an S1. We've already seen R3, so we're looking at a possibility of an S1 R3. I do expect to see the market move back above the 3,500 level for the close today. The S&P cash, we're seeing that the range for S3 today is 35.07. On the downside, 34.77 is S1. So I would expect to see a S1 R3. So I believe the markets will rebound as we come into the session early in the morning. There could be substantial amount of volatility depending on the statement and how markets are going to react to that. As we look at the weekly grid, this is an important event that's happening. We penetrated through the extreme. I talked about this 2 nights ago. 34.55 was the RXT. We've now seen a 35.01 in yesterday's print. So a close above that would set the potential for a sideways movement, but the sideways movement would probably be between maybe 34.80 to around 35.20 as we come into Monday and Tuesday of next week. Once we get an update on the grid on Sunday night, I'll bring in some perspective on what I think will happen there. Next market I'll cover is the NASDAQ futures. We are seeing a very flat session so far tonight. We have the S1 is 11,901. We've had a low of 11,922, so we're quite a bit above that. R1 is 12,004. We've traded just above that level, so it's been basically an S1 R1 range so far this evening. I do expect to see an S1, which we've already printed. I would call that done, and the possibility of an R2, which would put us over the 12,000 level. Now, we've seen a 12,016 level, but I expect we're going to finish over 12,000 today. In yesterday's action, we actually saw a 12,046. We did see a very sloppy close with the market closing back under 12,000. I think it will rebound and move back toward this level, and both the S&P and the NASDAQ will continue to move higher. Reviewing the weekly chart and looking at the weekly market grid, RXT is 11,981. We did print a 12,046 yesterday. So if we finish above that 12,981 today, this will set up the same scenario that we have on the weekly S&P chart, that we could get an RXT trigger suggesting a sideways movement, and I'll cover all this on Sunday night. The next market I'll cover is the 10-year. We did see an increase after the Fed statement yesterday. We did see a sell-off in the bonds and higher yields come into play as we moved up to the 0.74 level. I've been talking about an increase in yield. Most of the statement that Powell made yesterday is that they want a steepening yield curve. They do not want zero rates, and they want to see the 10 and the 30-year rates continue to increase. I've been talking about this for probably 2 months. It's been obvious to me based on their open market operations and other rhetoric that's coming out of the Fed that they do not want these negative rates. They're willing to do whatever it takes to keep negative rates from coming into play. I also want you to notice that the PPMs are just exploding here. There's a weekly graph, and PPM1 is at 0.78, PPM2 1.16, and PPM3 is still a negative number. It is ready to penetrate through its first derivative, which will be the first sign for the longer term trends to start to unfold. I do expect, as I've said for the last several months, that we're going to see higher yields as we go through the third quarter and go into the fourth quarter of this year. I don't think it's going to be drastically higher. The 10-year, I'm expecting to see no more than 1.1, and most likely we will stall out between 0.9 and 1%. The final market that I will cover will be gold. We saw a crazy range yesterday. The gold spiked up to the 1987 level. I've been discussing over the past several sessions that any move down below 1920 is a buy. We did see a 1908 low. We'll review the daily chart here in a minute, but we did see an entire range of what I've been talking about. It was 1979 on the upside, and then on the downside, 1920. Well, we printed that entire range. I'll go through that in just a minute. On a weekly basis, this 10-week moving average is a substantial support level. We've got PPM1 at a 0.98, PPM2 at a 0.73, PPM3 at 0.65. Anything over 0.25 is a uptrend. We have a substantial uptrend, and right now the 1906 10-week moving average, there's only a 10% probability for the market to trade below that level. We did print 1908. We bounced off of there. We're seeing some strength overnight, back up $21. We're at 1953. Today, the key number will be a close above the 1958 level. That'll put us over the 10-period moving average. PPM1 is turning up. PPM2 and 3 are all turning up. The gold market is continuing to structure out a bottom here, and we're likely to see a move toward that critical pivot area that I talked about over the last several days at 2015. Today will be very critical, so a close above that 1958 level will be a signal for higher prices moving toward 1984 to 2015, and we'll talk more about this on Sunday night. Thank you again for watching the channel and participating. We'll talk to you on Sunday night.